When you're in a low interest rate environment, that contributes to higher inflation, and higher inflation means the cash that you have in the bank isn't doing anything. It is being eaten away by inflation, and that's why Ray Dalio, the billionaire hedge fund manager, says that cash is trash. And in this video, I want to go over some investments that are better than cash when you're in this type of low interest rate, high inflationary environment. What's up, everybody? I'm Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. Ray Dalio is one of the most well-known hedge fund managers because his hedge fund Bridgewater was one of the most successful hedge funds because his company focuses on studying the data. They study historical data and they make their investment decisions based off of trends that they've seen happen in the past. Throughout the year 2021, Ray Dalio said again and again and again that cash is trash and you need to do something with your cash. That way you can get a better return with your cash instead of just keeping your cash in the bank and watching it get eaten away by inflation. Because when you are in a low interest rate environment, low interest rates mean you're going to see more people go out and borrow money. You're going to see more businesses go out and borrow money, which creates more inflation because more dollars are entering our economic circulation. And when you have more inflation, well, the value of each individual dollar goes down. So low interest rates, high inflation, which makes cash trash. When you're in a high inflationary environment, what you want to do is you want to be converting your cash into an asset that is getting benefited through inflation because now you own something that's going up in value instead of owning something that is losing its buying power every single day. Like through the year 2021 and through most of 2020, we saw the value and buying power of dollars go down while the price of stocks went up. We saw the price of real estate go up. We saw the price of cryptocurrency go up. So if you were one of the asset owners, you benefited because you got richer. You took your cash, you converted to one of these assets, stocks, real estate, crypto, and you became wealthier by doing nothing except owning the asset. But if you had that cash sitting in your bank account, you effectively became poorer because now it is more expensive for you to go out and buy stocks, and it became more expensive for you to go out and buy real estate, and it became more expensive for you to go out and invest your money into these type of assets, not to mention the fact that the buying power of your dollar went down. So not only is it more expensive for you to go out and invest your money, but it also became more expensive for you to go out and just live your life because your rent became more expensive, your groceries became more expensive, your vacations became more expensive, so the cost of living went up and the cost to invest went up while the people who invested their money saw the benefit. I love studying other successful investors. I really like studying Ray Dalio. I've read his books, I've read his papers, I've read the things that he does. And so what I want to do in this video is go more in depth into Ray Dalio's thought process and what he says that you can do with your cash, because as he says, cash is trash. That way you can benefit from the inflation that we have going on, because Ray Dalio says that there are 3 things that you should be doing with your money, 3 ways that you can get your money out of cash that way you can benefit from this inflation. But before we get into number 1, I need you to do me a quick favor and smash that thumbs up button below. And I know many of you have asked, Jaspreet, please bring back your shorter videos. I read the comments, so what we did was we created a new Minority Mindset channel called the Minority Mindset Clips channel, where I'm uploading my shorter videos every single day. These are my videos that are typically 8 to 12 minutes long. So if you miss my shorter videos and you want to see those in addition to these videos, check out the Minority Mindset Clips channel. We also have the Minority Mindset News channel, where Nate is publishing videos every single day on what's going on in the top finance and business news. So if you want to keep up with what's going on, check out the Minority Mindset News channel. And then we also have the Minority Mindset Spanish channel, where we're uploading my financial education videos in Spanish. So if you want to check out and subscribe to these new Minority Mindset channels, I'll put the link to where you can do that in the description below. In an interview, Ray Dalio talked about the 3 places where he says you should diversify your cash. What he says is rising inflation and low interest rates are creating risks for our investors, but cash is not the answer, because what he says is, quote, know that cash is trash. Don't keep it in cash. The most important thing that an individual investor can do is know how to diversify well. Ray Dalio goes on to say that you should be diversifying your money across 3 different areas. First is in different countries, second is in different currencies, and third is across different asset classes. He says that if you diversify your money this way, it will outperform cash. Let me start by talking about diversifying across different countries, because this is something that just recently I started to talk a little bit more about it. So the United States is the largest empire, the largest economy, the largest military presence, the largest country, the most powerful country in the world, which is great. But one of the downfalls with being so big is when you're so large, it's harder for you to grow very quickly. You could think of it like comparing a small growth startup company with a blue chip massive established company. When you're a small startup, you can be more nimble and you can work to grow faster and you can innovate and you can acquire more market share. So you have a lot more upside when you're small. Obviously you have more risk, but when you're large, all you're really trying to do when you're a big massive company is just grow steadily, continue to make sure you're getting your sales, continue to slowly drive revenue. I mean, you're just so big. You're a massive machine where you can't move as fast as you could when you're small and nimble. And so that's the issue with the United States. The United States economy is massive. We are the largest economy, the most powerful economy in the world, and so we just don't have the ability to grow as fast as we used to when we were a lot smaller. Back in our parents' and grandparents' time, it wasn't uncommon to see the United States economy grow by 5, 6, 7, 8, 9% a year. And so if you were investing your money into the United States economy, you were seeing a lot of growth because the economy was naturally growing as well. So you could see a lot of upside just because the economy had so much room to grow. Now, obviously our economy is still growing, it's still very powerful, but it just doesn't have the ability to grow as fast. And so if you were trying to see upside, well then you might want to consider investing your money into something a little bit smaller, like an emerging market, a smaller country where the economy is growing, because these countries are trying to grow a lot quicker, they can be more nimble, they can acquire more market share, versus the United States economy is more kind of like your blue chip. It's just slower, steadier growth, but if you want to see more potential upside, then you might have to consider moving some of your cash into some of these companies overseas or in these emerging markets. That way you can see more of that potential upside, especially now if you're trying to see higher growth. Because if we just think about inflation, if your goal now is to beat inflation and you want to outperform inflation and get a good return, well, that doesn't mean that you can just get a 1% or 2% return on your money. You're going to need a more significant return on your money. And one of the ways that you can do that to kind of counteract this inflation is by investing your money in some emerging markets. Now, there's a few different ways that you can invest your money in different countries. One is you actually go to the other country and you find investments there. The second is you try to invest your money into their stock exchanges. And third, which is the most accessible, is you invest your money into an ETF here in the United States, and this ETF can then give you exposure to these emerging markets. An ETF is an exchange traded fund. They trade just like stocks on the stock market. They have a ticker symbol. Here's a few examples I'll go over in just a second. They trade just like stocks. You can buy and sell them like stocks, but the difference between an ETF and a stock is when you invest in an individual stock, you're getting exposure to one company. If you go out and you buy one share of the Amazon stock, you only have exposure to Amazon. Versus when you invest in an ETF, you're getting exposure to an entire fund, which could be hundreds, if not thousands of companies. So 3 different ETF examples of emerging market ETFs are SCHE, which is the Charles Schwab ETF for emerging markets, VWO, which is the Vanguard ETF for emerging markets, and IEMG, which is the iShares ETF for emerging markets. Now, a little disclaimer, I do own VWO and SCHE. Now, in terms of the size of these ETFs, this one is the largest, this one is the second largest, and then the Schwab one is the third largest. And each one of these 3 ETFs go out and they invest in companies in emerging markets, countries like China, India, Taiwan, Brazil. So just depending on what the ETF is, different ETFs invest in different countries. They have different exposure to different countries. Like VWO has quite a bit of exposure to China. Other ETFs have a little bit more exposure to Korea or other emerging markets. So you got to see which countries you want to invest in. And then based off of that, you can also see how big of companies you want your ETF to be invested in. So for example, SCHE, the Schwab ETF, invests mainly in the larger companies in these emerging markets. So this has the smallest amount of actual companies in the ETF, and the reason being is they want to invest in your larger cap, bigger companies in emerging markets. VWO and IEMG also invest in bigger companies. They invest in like the mid cap to the large cap. But overall, if you look at the average size company in these 2 ETFs, they're not as big as the companies here. So you got to get an idea of, okay, which countries do I invest in? And what size of companies do I want to invest in? Then you can make the investment decision to see if this is a good investment option for you. Remember, you should always do your own due diligence and never blindly listen to a random guy on YouTube, because investing has risks and you're never guaranteed to make money when you invest. Now, inherently, when you invest your money into an emerging market, that is riskier. than investing your money into the United States because, like I said before, the United States has a very strong, very established economy, along with military presence, along with government. So when you're investing into these emerging markets, not only do you have the risk of these countries being smaller, they don't always have as strong of a military presence, they don't always have as stable of a government, but now the companies there will also be facing the uphill battle because now they're trying to grow in a smaller country. So you have to understand that there's inherently more risks when you invest your money into an emerging market, but it's one way for you to diversify your cash now outside of the United States, outside of this country, that way now you can get exposure into some companies and countries that are trying to grow bigger, faster. When you're investing in ETFs, whether you're investing in emerging market ETFs or any other kind of ETF, the way you win is not by trading ETFs, buying in the morning or selling in the evening, or buying one day and selling next week, or buying one day and selling next month. The way you win by investing your money in ETFs particularly is by investing your money for the long term. So the way you win by investing in ETFs is by investing your money consistently, passively, and then letting your money grow and compound over time. That's how you win with ETFs, because when you invest your money in ETFs, your goal is to invest your money for the long term. It is a long-term investment strategy. It is not a trading strategy. So you have to understand that there might be times where you see your ETF go down. And if you believe in your ETF, well, that is the time for you to come in and buy up more shares at a discounted price. That way you can invest for the long term. But the key to win is to invest for the long term if you believe in this idea of investing your money in outside countries. The second way that Ray Dalio talks about investing your money is by investing your money across different currencies. So the United States dollar is one currency, and then you have the Japanese yen, then you have the rupee. There's a bunch of different currencies. Many different countries have their own currencies, and the whole idea behind this is if you are worried about inflation, which is what we've been seeing happen for a long time now, and inflation continues to get worse, well, then that means that the value of the dollar will go down. So if you own some different currencies, you convert your dollars into different currencies, well, then that could be a protection against your dollar, because if the dollar starts to go down, then the value relative to these other currencies would go up. Now, I'm going to be honest. I am nowhere near an expert in currency trading or currency investing, but the thing that I want to talk about is he also mentioned cryptocurrencies. Going back to the article on the street, Ray Dalio says that if Bitcoin achieves widespread acceptance, then regulators will come in to control it. And he said, quote, "At the end of the day, if it's really successful, they will kill it because they have ways of killing it." Then he goes on to say that given Bitcoin's lack of intrinsic worth, it's hard to know what the cryptocurrency's ultimate fate will be, because there are so many things in a historical perspective that didn't have intrinsic value and had perceived value. They went hot and then became cold. Bitcoin could be one of them. So what he's saying is that the ultimate fate of Bitcoin is yet to be determined. Ray Dalio does own Bitcoin. He's talked about this in other interviews. He says that he does own Bitcoin. It's not a huge piece of his portfolio. It's a very small piece of his portfolio, but that is kind of like a protectionary hedge, kind of like gold. And to him, it's also a way to protect against inflation. But what he's saying is that we still don't know what's going to happen with cryptocurrency like Bitcoin. And there's a chance, according to him, that it could flop. And then the third way that Ray Dalio says that you should be investing your money is within the United States itself, is across different asset classes. So this would be things like stocks and real estate and businesses. So asset classes, businesses meaning not publicly traded companies. So what he's saying is not only diversify across companies in different countries, diversify across currencies, but then diversify within the United States with different asset classes. This does not mean that within your stock portfolio you have a blue chip fund and then a startup fund and then a healthcare fund. That is not diversification across different asset classes, because it's all within paper assets, stocks. So what he's saying is different asset classes, meaning things like stocks and real estate. Going to the CNBC article I mentioned in the beginning, Ray Dalio says, quote, "Cash is not a safe investment. It's not a safe place because it will be taxed by inflation." It's an interesting way to word it, that you're taxed by inflation, but it's not wrong, because when the United States government wants to spend money on their operations, they can raise their money by taxing people, so they raise their taxes, but they're never able to tax people enough, even if they raise taxes on the rich, to cover all of their spending. So what do? well then they print the rest of their money. So if they can't raise it by taxing, then they print it. When they print the money, this causes more inflation, and more inflation hurts the average person, the person who's not financially educated, the person who doesn't understand what's going on, because now your rent is more expensive, your groceries are more expensive, your life is more expensive. So you're taxed through inflation, because now if you just save all of your cash, this money spending causes more inflation, which hurts the average person. The concern a lot of people have is, why should I put my money in the market right now when we're close to market highs? We are at such high points in the market. Why should I put my money in and then risk a potential market crash coming in, and then I could lose a big chunk of my portfolio? And Ray Dalio addressed that. In that same article, he went on to say that you can reduce your risk without reducing your returns. He says you will not market time this. Even if you were a great market timer, the things that are happening can change the world, so it changes what could be priced into the markets. So what he's saying is you cannot perfectly time the market. Nobody knows when a market crash is going to happen. No one knows if it's going to happen tomorrow, next year, or in 5 years or 10 years. There's no way to time that. But what he's saying is we have a lot of other things happening in the world, like inflation, which is a big concern. And if you don't do something with your money, well then this inflation can eat away at your money, and it could affect the markets, because what that means is if inflation started to get really bad, the value of the dollar goes down, and you start to see, even if it's a minor dollar crisis, well, in turn, that makes the price of assets like stocks and real estate go up, which means that now it's more expensive for you to go out and use your dollars to buy stocks and real estate because of all this inflation. So it's kind of like a reverse crash where the value of your dollar crashed, which in turn makes it more expensive for you to go out and buy stocks and real estate. So even if your stocks and real estate aren't more valuable because, it's just that the value of the dollar went down, it'll be much harder for you to go out and buy stocks and real estate with your dollars just because the value of your dollar dropped. Ray Dalio says that the excess money supply in the system could create certain economic and political problems. He went on to say, quote, "You cannot raise living standards by raising the amount of money and credit in the system, because that's just more money chasing the same amount of goods, and it will affect financial markets the same way we've seen, and it will affect the inflation rate. It won't raise living standards in an important way. As inflation then begins to bite, it has political consequences." The easiest way for me to explain that would probably just be by diagramming it out. So let's assume that you have 5 people in this world. 1, 2, 3, 4, 5. In this world with only 5 people, each of these 5 people only have $100 because that's just the way the world works. And in this world, they all want to be able to purchase this car. You only have one type of car in this world, and this car costs $50. Well, let's assume that suddenly each person in this world went from having $100 to $1,000. Now, all of a sudden, each one of these people are going to feel richer. And let's also assume that the way that they grew this number of dollars that they had, I can't say wealth because you'll see why in just a second, is the government here said, you know what, we are going to print this money out of thin air, and we're just going to make you all richer. So the government gives each person $900. So the government gives each person $900, each go from having $100 to $1,000, and everyone says, holy cow, I am rich. I just 10x'd how much money and wealth I have. Well, what's going to happen? Do you think this car is still going to be on sale for just $50? No, because there's so many more dollars in circulation. The value of each individual dollar went down. Nothing was produced to actually create more wealth. The only thing that was created was more money out of thin air, more dollars. And so what happens is each individual dollar goes down in value, which would cause, in turn, the price of this car to probably go up to $500. So you felt rich for a minute because now you were like, hey, I got some more money out of thin air. But then over time, you're going to realize that you're no more wealthy than you were before. I mean, if immediately you got this new money and it hadn't gone into the economic system yet, you could have gone out and bought 10 cars or 20 cars. You might have felt richer. But eventually this car owner is going to say, wait, these dollars that I'm getting aren't worth as much. And so then the car owner is going to say, I can't keep selling cars for $50 because it's costing me more than $50 now to produce this car because the value of the dollar keeps going down. I keep getting these dollars from these people, but the dollars aren't worth as much. So that's why this car owner will then be forced to raise the price of the car to $500 to meet the market, which means that now you have more dollars, but you're no more wealthier than you were before. That's what he's saying. You cannot raise the living standards of people by just creating money. You create money, you send it to people, you give it to people, you have it inject into our economic system. Then people take these dollars and they go out and they spend it. They go out and buy things. These things are made overseas in China and India. And then these countries and companies say, okay, we'll accept your dollars for now. They produce products, real things, real goods. They ship it out to the United States, created a supply chain mess because we created demand out of thin air. People suddenly started living a whole lot bigger. They started living a whole lot nicer without actually producing anything because the government was producing money out of thin air. And then now you have all these orders coming in. You have the backlogs of people, and it came from what? There was no actual production of value in the United States. The only thing that we produced was dollars. So we produce dollars, enter it into our economic system. People that have more dollars, they go out and spend it, and then that causes the price of things to go up because then the producers say, yeah, we're selling stuff and we're getting these dollars, but these dollars aren't enough anymore to cover the cost of our goods, which then cause the price of things to go up. And then people suddenly say, oh, I thought I was wealthier. I was spending so much money, but I'm no more wealthier now than I was before. This is the concern with inflation that Ray Dalio is talking about. And the reason why he's saying it's going to cause economic and political issues is because, well, we've already seen a lot of social, political issues over the last decade. And now as people don't feel included in the system, anytime you see a bigger divide between the rich and the poor, well, that creates more unrest. Well, who do you think inflation benefits when inflation happens? Because when people get this free money, when they feel like they're wealthier, what do they do with it? It's not that they take this money and they go and invest it in themselves, they pay off their debt. I mean, sure, you have some people that do that, but the average person takes this money and they go out to Kroger, they go to Amazon, they go to Lululemon, they go to Apple, and they go and spend this money. So the money flows right up to the top. The money flows to the rich and wealthy. And so this money gets printed, it gets created, enters the economic system, the people get it, people spend it, it flows to the rich and wealthy, and now you have a bigger concentration of wealth, a larger number of dollars controlled by the rich and the wealthy, and now the poor have a smaller concentration of dollars, and each individual dollar isn't going to stretch as far. Each individual dollar doesn't have the same buying power as before, and this now creates a bigger divide between the rich and the poor. Like I said before, anytime you see a bigger divide between the rich and the poor, it creates more social unrest. So this is what he's talking about. That is the concern. Because now when you create more inflation, it benefits the wealthy, it benefits the financially educated, and it hurts the average person. The average person pays the price for inflation, which is why it's called a hidden tax, because it is a way for the government to raise taxes without actually legislating anything. Because if the government wants to raise taxes on people, they have to get it approved. But if they just print the money, well, then it's not as hard, and people say, oh yeah, great, we're spending more money. But who pays the price for this money spending? The average person. Because now your groceries and your cars and your vacations and your rent become more expensive because the dollars that you use to go and buy these things no longer stretch as far. The last thing that Ray Dalio said is, quote, what we're seeing happen has played out many times in history. It's like watching the movie over again. So when it comes to investing your money in different asset classes, what Ray Dalio is saying is, yes, we could potentially see a crash, but he says the bigger risk is what could happen with inflation, which is why you don't want to try to time the market, and you want to continue to invest your money smartly across different asset classes. That way you can put your cash to work, because your cash in this environment is a liability, or as he says, cash is trash. What should somebody be doing with their money to protect themselves against this type of inflation?
Well, the worst thing that you can own, obviously, would be any long-term bonds. The longer the maturity, the more you're going to lose. When inflation is the threat, bonds are not where the solution is.